Hello and welcome. This discussion, put together for you by our friends at My Tax Accountant, is going to tackle a huge topic for anyone holding crypto in the UK: tax. Now, I know it can feel like a complete maze, but don't you worry, we're going to break down exactly how HMRC sees your crypto piece by piece. Let's get right into it.
So, let's say you've had a pretty good year. Your portfolio is looking healthy, maybe you've cashed out some of those gains, and that feeling is just fantastic. But then what happens? Almost immediately, that little voice creeps into the back of your head, doesn't it? What about the tax man? It's the one question that can turn all that excitement into a bit of a headache. And for good reason, because believe me, HMRC is paying very, very close attention.
Okay, so before we go any further, there is one thing you absolutely have to get your head around. This is HMRC's golden rule, and it changes everything. In the eyes of the UK tax authority, your Bitcoin, your Ethereum, it's not money, it's not currency. It's classified as a crypto asset, which is basically a type of property. Now, this isn't just about wording, it's the foundation for every single rule that follows. Because it's treated like an asset, kind of like a stock or a house, it means that almost every single thing you do with it could have tax implications. So let's map out how we're going to untangle all of this. To make this all crystal clear, here's our game plan. First, we're going to look at what HMRC thinks and why this is so critical right now. Then, we'll tackle the biggest question of all. Is it capital gains or is it income tax? After that, we'll break down both of those in detail, cover how you can stay on the right side of the law, and finally, chat about getting some expert help when you need it. All right, first up, we really need to get to grips with HMRC's current stance. You might be sitting there thinking, why is this suddenly such a big deal? Well, the whole landscape has shifted a lot in just the last couple of years. And this chart, wow, it tells you everything you need to know. Just look at the jump in the amount of tax HMRC is pulling in from crypto. From about £200 million in 2021 to a massive $350 million in 2024. This isn't just happening by chance. It proves two things. One, more people are getting their taxes sorted, which is great. But more importantly, it shows that HMRC is actively and successfully chasing this stuff down. The days of this being a niche interest are long gone. Okay, that brings us to the most important question you need to ask yourself about your own crypto activity. Is it a capital gain or is it income? Honestly, getting this part right is the first and most crucial step. It decides what kind of tax you'll pay, the rates you're looking at, and what allowances you can actually use. So here's the simplest way to think about it. It all boils down to whether you are investing in crypto or earning it. If you're buying crypto, holding it, hoping its value goes up before you eventually sell it, trade it, or spend it, that's investing. And that falls squarely under capital gains tax. On the other hand, if you're actively getting crypto as a payment or a reward, like being paid for your work, mining, or from staking your coins, well, that's earning. And that's treated as income, which means income tax. Let's make this really concrete with a quick cheat sheet. Selling your crypto for good old pound sterling, that's a classic capital gains event. Swapping your Bitcoin for some Ethereum, that's also capital gains. But let's picture a real-life scenario. Imagine you're a freelance web designer in London and your client pays your latest invoice in Ethereum. That ETH you receive is taxed as income based on its value the day you got it. Same goes for any serious mining operations or those staking rewards, it's all income. Okay, since most of us start out by investing, let's really zoom in on capital gains tax, or CGT. This is simply the tax you pay on the profit you make when you get rid of an investment. Now, in tax speak, a taxable event is called a disposal. This word is so important. It doesn't just mean selling for cash. Swapping one crypto for another, that's a disposal. Using your crypto to buy a pizza or a new laptop, that's a disposal. Even gifting crypto to a friend is considered a disposal. The main exception here is if you're transferring it to your spouse or civil partner. That's generally tax-free. But for everything else, you need to work out if you made a profit or a loss. Now for a little bit of good news. Everyone in the UK gets a tax-free allowance for capital gains each year. For the 2025/2026 tax year, that magic number is £3,000. This means you can make up to $3,000 in profit across all of your assets, not just crypto, before you have to pay a single penny in capital gains tax. Just a quick heads up though, this allowance has been coming down recently, which makes tracking your gains more important than ever. So what happens if your profits go above that £3,000 allowance? Well, that's when the tax kicks in. The rate you pay depends entirely on your income tax band for the year. If you're a basic rate taxpayer, you'll pay 10% on your crypto gains. If you're a higher or additional rate taxpayer, that rate jumps up to 20%. Let's walk through a quick and easy calculation.
Let's say you bought some Bitcoin for £1,500 and a while later you sell it for £4,800. Step 1, your profit is the sale price minus the cost price, which leaves you with £3,300. Step 2, you take away your tax-free allowance. So £3,300 minus £3,000 leaves just £300 that's actually taxable. And step 3, assuming you're a basic rate taxpayer, you apply that 10% rate, which gives you a final tax bill of just £30. See, when you break it down, it's not so scary after all.
So that's the investing side covered. But what if you're earning crypto? Let's flip the coin and have a look at when income tax gets involved. This is for all of you who are getting paid or rewarded directly in crypto. So when is crypto treated like regular income? Well, the main scenarios are if your job pays you a salary in crypto, if you're running a serious commercial-scale mining operation, or if you're earning those staking rewards we talked about. Some airdrops can also count, especially if you had to do something to get them, like sharing a post on social media. And finally, if you're trading so often and with such a level of organization that HMRC sees it as a business, your profits would be treated as trading income, not capital gains. When your crypto is treated as income, you simply use the standard income tax bands for the 2025/26 tax year. The pound value of the crypto you earn just gets added on top of your other income for the year, like your salary from your day job. You still get your personal allowance. That's $12,570, where you pay zero tax. After that, you fall into the usual basic, higher, or additional rate bands. And don't forget, national insurance might be due on that as well. Okay, knowing the rules is one thing, but proving you followed them, that's a whole other ballgame. This section is absolutely crucial. It's all about keeping the right paperwork and avoiding the simple mistakes that catch so many people out. Stay with me, the next point might surprise you. So let me ask you a question that I see come up all the time. You've got some Bitcoin, you go on an exchange, and you swap it directly for some Ethereum. No money has gone back to your bank account. Is that a taxable event? The answer is a big, resounding yes. Honestly, this is probably the biggest misunderstanding in all of crypto tax. As far as HMRC is concerned, you have disposed of one asset, the Bitcoin, and you've acquired a new one, the Ethereum. At that exact moment, you have to work out the pound value to see if you've made a capital gain. It is a taxable event, and it's this rule that makes the next part so important. Because of rules like that, keeping meticulous records isn't just a nice to have, it's absolutely essential. For every single transaction, you need to be recording the date, the type of crypto, the amount, its value in pounds sterling at that moment, and any transaction fees you paid. Pro tip, you can often deduct those fees from your profits, so tracking them will literally save you money. And you've got to keep these records for at least 5 years after the tax year they belong to. Now, if you're thinking, oh, it's fine, my stuff is all on decentralized exchanges or in a private wallet, then you really need to hear this. HMRC is not playing around. They openly state that they use sophisticated blockchain analytics tools. They have the power to trace transactions and connect activity from so-called anonymous wallets right back to the accounts you have on regulated exchanges where you've proven your identity. Trying to hide is not a viable strategy. Which brings us neatly to our final section. We've covered a lot of ground here. The rules, the numbers, the common traps. It is complicated, and the stakes can be pretty high. This is exactly why trying to navigate this maze all by yourself might not be the best idea. And listen, if your head is spinning a little bit right now, please know that is completely normal. This is a new and complex area of tax law. The rules have a lot of nuance, the record keeping is a real chore, and the tech is always changing. It's perfectly okay to feel like it's a lot to handle, because it is. But you don't have to handle it all alone. For genuine peace of mind, working with a specialist is the smartest move you can make. The experts at My Tax Accountant live and breathe this stuff every single day, and they can take all of that stress and confusion off your plate. All their contact details are right there on the screen. Give them a call or send them a message. Thank you so much for joining me for this breakdown. I really hope it's cleared a few things up for you, and if it has, please do consider subscribing for more guides just like this one.